I always forget. So welcome back to the Compassionate Capitalist Show. Karen Rands here, of course. And today we are going to cover the topic of valuation. It is probably one of the, for a lot of people, and particularly in my space of startups and stuff like that, it is probably one of the biggest EBGB, Wizard of Oz kind of things that you can think of is how do you come up with valuation? It is such a point of pain for investors and entrepreneurs in a pre-revenue type of a company on figuring that out. There's generally this kind of school of thought approach, but more times than I care to think about, I've been involved in situations or had a situation where a company, because the entrepreneur had no idea how to do their valuation, came up with a wish list number that completely impeded their ability to raise capital, or they find themselves into this ugly situation of having to do a down round. And so that is, it is, but there, so, in my world, and for a lot of the folks that listen to this show, that's kind of your perspective on valuation. But again, the purpose of the Compassionate Capitalist Show is to really take the idea of starting a company or investing in a company all the way through to the exit. And when you're going all the way through to the exit, there are many areas where evaluation, an objective evaluation, meaning not based on emotion, not basing on wishing it was valued at this or thinking it's got this thing because you did some weird future value of 1% of a huge market and then try to do a net present value back on that. Now you see it like that. But there's very tangible ways to measure the value of the company. And we're going to cover that here in just a few when I bring my guest, Gregg Ficery, on. All types of valuation. And so let's talk about that, right? There's reasons, there's the fundraising, as I said, but also now that you have these crowdfunding platforms like a Reg A Plus, you have to have a real valuation because of the kind of financials you're doing, the kind of offering you're doing, because you have existing shareholders that may sell on the platform as well. The value of what your strike price is going to be becomes very important in the success of that kind of capital raise. And if you're, considering going into an IPO, right? There's also when you're getting ready to sell the company, and that's what is it that you're going to sell this company for? What is that valuation? And in the situations where you have stock option pricing or employee stock option programs all the way through as the company grows, when you're doing due diligence to purchase another business or a sale of a division of your business. And then there's the unavoidable situations of bankruptcy, or, which is a fairness opinion and solvency opinions, but then also litigation. When you have to, you have a litigation between an employee that believes that they are owed something, or a partner that's leaving and you got a buy-sell agreement that you've got to come up with, or you're getting a divorce and the business is an asset within that household, and what is that going to be worth? Or in the event of a death, and now you've got somebody it's part of an estate settlement. So these are all aspects where the valuation of a business becomes a critical and unavoidable aspect of what you have to do. And I have as I mentioned, but Gregg's coming on, the perfect person to educate me and you, my listening audience, because as I say, interviewing experts makes me smarter than the average bear, but does not make me the expert. So I'm going to introduce Gregg here, tell you all about him, but I want you to make sure you stick around to the end, because you're going to hear how Gregg has fulfilled a dream, a bucket list item that is really bringing great joy to the world. And you're going to want to hear what that is, why he did it, and how he did it, and how you can be involved in sharing that joy as well. So with that, here, let me tell you about Gregg. First of all, say hello, Gregg.
Hello, Gregg.
Gregg's
Hi,
got
everyone.
that great word.
Thanks for having me, Karen.
Absolutely. So Gregg Ficery. Am I saying that right?
It's Ficery, actually. We see
Ficery.
Ficery.
Okay, Ficery. Thank you for letting me correct myself on that. I meant to ask that at the beginning before we started, but then I didn't. So, and it does have it's Ficary for those that are just listening. I don't see the CAR
Ficery. Ficery. Yeah.
If you're watching on YouTube, that you see his name in the corner there, okay, so we're all set there, right? So he is the president of Integgra Valuation Advisory Services, which was founded in 2011, has over 20 years of business valuation consulting experience, has valued nearly 1,000 private companies. That's a big number. He also has 10 years of industry experience in the technology, telecommunications, financial services sectors, and financing, accounting, and corporate development roles. He's an active speaker on business valuation topics and an angel investor. Integgra is also an active sponsor of several organizations in the startup community in Atlanta. And that's actually how I know Gregg, through ATA, Atlanta Technology Angels, and their events. TIE Atlanta, they now like to call themselves the Innovative Entrepreneur Organization. Atlanta Technology Village, the Atlanta Technology Development Center, the Atlanta CEO Council, and Goody Nation. And he's very much involved in our entrepreneur investor ecosystem organizations. And I have been talking to Gregg about having him be a guest on my show for probably a couple of years now. And when he came out with the thing that I'm giving a lot of suspense on, because I want y'all to stick around, I was like, yes, we're totally going to do that. And then I saw an interview that he had, and I said, yes. And we were at an event, a Thai event last week. And I said, right now, we're going to put it on our calendars and we'll record this. So with that, officially, hello, Gregg. Well, thank you so much for finally coming on my show to talk about valuation. Yes, we did.
A dream come true. Another one.
Yes. All right. So I kind of set the stage of the different pieces of that. And I'm gonna let you talk about the intangibles and the tangibles and those kind of things. But first, how did you get involved in valuation? How did you go to start your own firm? Give us a step back, just a step, because did you go, is there a college degree you get for valuation, or is it just like finance and you just sort of learn it over time? Or how does somebody become an expert in valuations?
Great question. Like, who grew up saying, yes, I want to be a business valuation consultant when I grow up, right? That was not a thing. And there was no degree for such things. I did have a finance degree from Georgetown, so I knew I wanted to be generally in the financial services world. I really didn't know what or how. I knew I didn't want to go to Wall Street and be an investment banker in one of those 2-year analyst programs. Too much of a grind, and New York wasn't, especially then, wasn't a place I wanted to be. It was sort of the Wall Street movie era, the Gordon Gekko era, Drexel Burnham in real life, Michael Milken. Companies were blowing up. It was a Wild West sort of time in finance. For those of us old enough to remember the 80s, 90s, there was so much corruption, and it for a Midwesterner like me growing up in Pittsburgh, it's felt a little too much. So
yeah. And they've made a few movies about those crazy times. That's how crazy it was.
If you haven't seen Wall Street, go back, or watch it again, because it's even prophetic. But so I loved Washington. I loved Georgetown. I stuck around there, and thinking I'd avoid corruption, ended up working for a company called Freddie Mac for 7 years. So kind of, the fire or the frying pan. But I left there in 96, and that was before things hit the fan there. But then as things went, I got married, moved to Atlanta after finishing my MBA, and worked for a company called MCI in Atlanta when telecom was cool. And then that became WorldCom. So boom, another, implosion.
Oh yeah. We have a common ground there with that implosion and career shifting things. So yeah.
So that ended in 99. After WorldCom took over, I kind of saw where things were going there with the Mississippi Mafia. And Bernie Evers in jail, died just recently. I think they let him out to die, but at the end. But so then the .com thing happened, and it was exciting, and I thought I would try that. And I worked for a subsidiary of Atlanta-based IXL that Bert Ellis ran. It was a financial services marketplace called youdecide.com. That was their their website, but the company was called Consumer Financial Network. And I was the director of business development there. I did a lot of partnerships, and I really enjoyed the excitement of a startup, but it didn't work out. And I had 50,000 worthless stock options. So I was introduced to the concept of stock options. And, what became apparent after the fact and with some experience, which is still the case today, ironically, the employees that accept a stock option package as a part of their compensation really have no insight into their value or the valuation of those options. They have a strike price, but they don't know relatively, are they in the money or out of the money? They don't even know what in the money might mean, or are they, it's a cost basis in terms of like a regular public stock. But they don't know, there's no daily market. They can't tell what the company's
Sure.
worth, and that's not something they have visibility to. So it's a leap of faith, largely, which is tough to accept if you're trying to make an intelligent, fact-based decision. So as it happened in that .com era, then there was a lot of corruption with stock option pricing. And at that time, oddly, companies were able to set their own strike prices. So there was a lot of manipulation there. And they would often set them too low, even at a penny or something per share, just to give everybody a lot of upside. Sometimes, however, they would set them too high, either on purpose or just because they didn't know what they were doing. And then nobody had any upside in those options. So a lot of people, even executives, went to jail over such things as well. If you've seen the BlackBerry movie lately, which has kind of come out on Amazon Plus or Netflix, about before the iPhone was the BlackBerry and all the buttons.
Yeah.
There was something, the issue of option pricing backdating was seen in that movie, how they offered developers from Google and other places to come in with artificially low penny type stock options. And they got in trouble with the SEC over that. And they weaseled out of it to some extent, but a lot of executives went to jail over that kind of
Really?
thing.
So let me ask a question about that. So it's because they put it low so that the return on that stock when it has an exit is higher. But isn't
Right.
is it securities? But it seems like there would also be an IRS issue.
It's securities
that.
fraud, and there's they're not. The IRS does care. They don't care if you issue options too high, but they do if you artificially enrich yourself by putting option prices too low. So, for example, if it's a public company, it's trading $1 a share, and you give somebody, that starts working their options at, they call it backdating. We'll give you last year's price, because we had some left over in last year's pool for 50 cents a share. So you're giving them more upside on things.
So now, is there a bit, because stock options is one of the things that we want to kind of get into talking about the pricing on that. So is it okay if I just jump in and sort of talk about that?
Segue.
So is it stock options always at market? To talk about that market rate of if it's not public yet, then it seems like part of a purpose of a stock option is there's some kind of discount. So is it a fixed discount then? And that's what makes it legal? It's like it's 20% coupon or something like that, or.
So just to tie off on that, after the .com experience, it became necessary. The government passed the Sarbanes-Oxley regulations, which required, which included this IRS 409A valuation that required companies issuing options, private companies, to get those strike prices set independently by valuation consultants at least once a year or more often if there's a
Oh.
funding or material event. So I got recruited then to join my first valuation firm. It was sort of the Valuation Employment Act, that 409A thing. And so companies went to find service providers to do that. And valuation firms, the few that existed, needed to start doing that. And I worked for 2 firms, kept growing, kept getting recruited. I was very marketable, so I get better offers. And then the 3rd firm that recruited me was Silicon Valley Bank. Another
You
boy.
pick the good ones, don't you?
Hey, I've reflected a lot on this, believe me, and it has something to do with my company now being called Integgra. So, everybody, those clients of SVB were asking, where do we get this done? And so they said, hey, we'll start a group. There's some stickiness to that. And they tried to do valuations for a few years, and they got thousands of clients, but it was very hard for them to do profitably with so much overhead because they're not, super big ticket items. So we sort of saw the writing on the wall, and I left to start my own firm because I saw that I could do it for less than they were charging, do it profitably, and have a life again, because we were really grinding out thousands of valuations a year there. It wasn't really enjoyable. So I'm enjoying my life again, and having freedom to work on this other project as well.
Tease,
So
tease, tease.
that's kind of how I got into it. But yes, there are certain discounts that are applicable to the share price, the literal share price of a private company, for 2 specific things called a lack of control and a lack of marketability. So in other words, if you're a minority shareholder, less than 50% shareholder, and you would get a discount for not having voting control and such things. And you also have a discount because it's not liquid in the market for several years, probably. Like, you can't trade it, and have your cash in 3 days, like on E-Trade. So relatively, you end up with roughly, 40-50% discount off of the actual value per common share in your options.
So is that set up? Is there like rules like FASB rules, accounting rules, or something? They're like the in Sarbanes-Oxley, do they set like specific things to measure that on, or is there still a subjective element to it?
It's somewhat subjective. There's the AICPA has some guidelines. There's the American Society of Appraisers and a couple other standard bearers. And they give you certain mathematical models to try to quantify those kinds of discounts. And there's other methods that are prescribed to determine the overall value of the company that we'll get into. But ultimately, there's subjectivity, and based on the stage of the company, their growth, their size, and think about, what those discounts should be. But the IRS, when they review these things, they have sort of guidelines in mind and guardrails. Like, if you get too aggressive, they can raise a red flag and issue penalties against the companies and the stockholders, option holders, for those cheap stock things.
So is that, when it's a private company and they're not reporting to the SEC or FINRA, I guess, or any of that kind of stuff, does the SEC come in and check, or do you file paperwork? Because there's this form that you do. So they've got sort of a checks and balances while they're private, or is it a look back
IRS,
when they go public?
The IRS, not the SEC. The option, the 409A and another form called ASC 718, which is the option expense form. Companies do have to take an expense for the options that they issue, which and that is sort of derived out of the 409A result, and we do some of those as well. All get submitted, with the IRS, and they may review them, and you may be subject to audit over such things.
Okay, so now I remember a while back there was this big thing, and it kind of came out of Silicon Valley and all the .coms, and it was like this phantom taxes or things, something like that, where people would be getting taxed on that value, but they haven't actually received any money for it. It was something along those lines, that people, they had to go and do a new rule, a tax IRS rule, because, do you recall that? I don't know. It's probably
It's
so
something
long
called
ago. It's not a.
83B. I'm not sure if that's what you're thinking about, because there's a difference between option grants and or equity grants and options that are vest over periods of time. So if you're granted equity or options in 1 year, then those are taxed in that year and need to be valued for tax purposes. Otherwise, you're not taxed until the options are exercised later.
Oh, so now, and a private company, they can choose. Do they need to choose that for the way they're going to do it, like at the beginning of an employee option program versus, or just at each time they release it, do they do it with, like, they do this year, this is how it's going to be done?
It's called an 83B election, and I believe the election is on the end of the option or shareholder. I'm not sure if all employees have that election or just certain levels of executives. It's a little, I don't have total visibility into the tax side of that, but I do valuations when the 83B election has been chosen.
Okay. All righty. So, all right. So that's that. Let's kind of use that too as sort of, segueing into private versus, I mean, I guess a lot of companies are private, even when they're getting ready to sell and do all this kind of stuff. But let's go with this, like, do it from a pre-revenue kind of a thing, or a little tiny revenue. The difference between a startup or a seed stage, when they're raising capital and they're raising it on this future expectation of value, right? So a company that, the general rule of thumb that we had been using in the marketplace for like a seed stage is that a tech company is going to be $1 million or $2 million. So they raise 250,000. And then once they get their product done and they know, they're starting to get into revenue, and they know they validated their market, they might go up to like 5 million, and raise $1 million, that kind of sort of traditional model. And then there you get the ones where, like one of my pet peeves of unicorns, and there's so much, because so many people don't understand that a big part of how a valuation gets set once they start raising capital is how much money that has been put in. So like if a company is a $5 million company and pre-money valuation is 5 million, and they raise $1 million, their post money is 6 million. But then the next round, they may be at 25 million, but there's not always tangible assets that gets them. It's still based off of future perspective. So share with the audience if that is like old school thinking, and they don't even do that kind of stuff anymore, and this is how it's done, or how you navigate within that with private companies, helping entrepreneurs not set too inflated of a value that's going to impact, their ability to raise capital based on their stage.
Okay, so first thing I would say is there's no such thing as like old school and new school valuation.
Okay, good.
There's only one school, and by definition, what's that dangerous line? Say, well, it's it doesn't work that way. It's never, it's a new paradigm, or what, it's a new world. The old rules don't exist. No. So by definition, the value of a company is the present value of its future cash flows, its discounted future cash flows. And those are the DCF models, discounted cash flow. It's Finance 101 in college or business school. And it just is what it is. And so it's the most accurate method of valuing a company, but you have to have positive cash flow. But it's specific to your company. By definition, it's not a market approach based on like a home appraisal, homes in your neighborhood, homes in your zip code, homes in your state, whatever. And those are all by somewhat, by definition somewhat dissimilar. So they're larger, they have more diverse product sets, whatever. They're not just like your company. So taking cash flow or EBITDA, market multiples, earnings before interest, taxes, depreciation, and amortization on your income statement. Just EBITDA multiples are better than revenue multiples because two companies that have the same revenue but different profit margins aren't worth the same thing either. Revenue multiples are very dangerous. And this whole 10x SaaS, revenue multiple myth is something that's, out of whack and just not true. Especially in lower markets, but talk a little bit more about that. So working backwards, if you have positive cash flow, you want to value a company with a DCF income approach model. But as we're talking with a lot of startups, don't have positive cash flow, can't do that, can't do EBITDA multiples. Maybe you can try revenue multiples if that's the only thing you can do. But even then, if you're pre-revenue or minimal revenue, how do you do that? That's to your heebie-jeebie, mystic stuff at the comment you made at the beginning. It's mysterious to people. And I try to demystify that for people with a method that I've extrapolated, didn't create it, but there's something out there called a scorecard method that was written up by a fellow named, I think, Bill Payne. And I put it into a model that's very data driven, so it's not totally subjective. I try to make it as objective as possible, feeding it with funding data from over 10 years. I track from available sources, but there's challenges with that too. You can't just say, well, the national median angel stage valuation last year, as reported on PitchBook or whoever, was $7 million or something. I mean, it's been up and down. Over 10 years, it's gone from about 2 something to about 7, and now maybe back to about 5-ish, but whatever that number happens to be. That was only as of the end of the previous year, or if you're lucky, the previous quarter. So markets change throughout a year, and that's your first thing. You have to make an adjustment and be thoughtful about how you do that for where the market is now in August of 23 versus the last available data from the end of 22. So the markets generally, overall, indexes are up this year, but that's very sector driven by AI and other things, and many are down. So B, you have to be thoughtful about the sector. Certain SaaS sectors, healthcare, tech, fintech may be hot. Others, B2C, ed tech, maybe, cold, agriculture tech, so on. So have to dig into that. And so sector, time of year, and size is also a factor too. A pre-revenue company, to your earlier point, is probably worth less than a pre-seed company. That term came into being a couple of years ago. Just between angel and seed, there's pre-seed. So 250K, 500K, as you work your way up, valuations increase. And that's why the 10x revenue multiple is a myth, because even in SaaS companies, data that I spent a lot of time researching showed that it wasn't until you got to even over $1 billion, closer to $2 billion in market cap, that those companies would show 10x revenue multiples.
Really?
Yes, even under $1 billion, even 100 million EV companies were 3 and 4x revenue multiples in the public markets. And then once you get down to 50, 10 million and less, the revenue multiples in public companies were like 1 and 2. So it was really surprising result from that research project.
Now, let me just ask real quick in there. So is that part in that because they're so big, a 10x multiple would be a really huge number versus a lower number, because so there's a ratio or a yin and the yang based on how big and what the multiple is, and that might be a factor, or is it they'll get up to like a 10x, as you mentioned, because it's a hot sector, because it's the thing that's happening and there's acquisitions in that sector, and because of these other things that drive it as a multiple as much as just the size of the company?
I think risk is a huge piece of that. It's probably not the only piece, but it's just de-risked when you've established market dominance and market share and profitability. And so a company with $1 million in revenue, they were commonly thinking that they'd be worth at least $10 million and profitable or not. And it was happening for a bit in certain sectors and certain times. I mean, I think the fourth quarter of 2020 was the peak, but multiples have taken a big hit in some sectors. Fintech, I think, was the most overvalued, and last year there was data showing that their multiples were down about 80%. So they were up to like 25 times revenue, and then they were down to like 5. To your earlier point, which was right on the spot, when companies make mistakes in their pitches, and this is when they come to me, at the earliest point, what should I pitch at to give myself the best chance of raising money? If they ask for too much, they're going to be, Mr. Wonderful is going to laugh them right out of the room. Even get to show them, what they do. And it might be the greatest thing since sliced bread, but if the valuation is too high, it's just not investable.
Mm-hmm. Yep.
So we try to keep them in the game, but being too low isn't good either, because then you give away too much of the company. And that's what entrepreneurs are afraid of.
Right.
You have to leave yourself room to raise more money without losing control of, which means you want to raise 2 or 3 rounds without giving away 50% of the company. So a good guideline is never to sell more than 20% of the company in any one round, but that means that you probably don't want to ask for too much at the beginning either. You want to raise as little as possible, bootstrap and show progress, show traction, build confidence, and then you can raise more a second time at a higher valuation. But
Yeah,
this doesn't make sense.
It might be worthwhile to just sort of step back for folks that kind of are new to some of this language that we're talking about. And this is where, because I know one of the fear factors that both investors and entrepreneurs have is that dilution or the value of my shares, and they'll put in, like, sometimes angels will put in these clauses for anti-dilution or VCs and stuff like that. And I tried to explain that is a no-win type of thing in both cases. If the companies are doing what they should be doing and they're doing like what you say, so let's say it's $1 million and they're raising 200,000, something like that, it's 20%. The next time they've increased their value, they've got customers, they got a product, and let's say it's 5 million and they're giving up another $1 million, or raising another 20%. They haven't given up 40% of their company, because that first group reduced down to, at the new valuation, 250,000 on, to about 5% of the company instead of 20. And then they gave up 20%. So the entrepreneurs have given up 25% altogether within those 2 rounds. Am I right in the way I'm kind of doing that kind of stuff? Because I try to help people not have this fear factor of that, because your stock that started out at 50 cents, let's say it was in that first example, and it's now it's actually worth $2.50. So you still have the same number of shares that are now worth 5 times what they were before, even though you have less percentage of the company.
Yeah, you have a smaller piece of a bigger pie.
Yeah. So did I do good there, Greg?
I think so. I was trying to sum it up without breaking down the math, but generally, yes, just pick a number, angel investments tend to be about 10,000, 20,000 bucks for at ATA or something like that. You know, if I went in at 5 million, with a group of angel investors, let's say we put in $1 million total, that was, you're correct. It's $1 million is on 5 is 20% pre-money, but you add that million to become 6 million. So the post money is 1 on 6, which is 16.6%. So
yeah.
the group, you know, effectively the company sold 16% of the company, not 20%.
Yeah, that's a good point. That's a really good point to drive home, because it also still goes to that like, to me, the big, you know, investors want the most amount of shares they can get for their money because of this other fear, and entrepreneurs want them to get the least amount of shares because they don't want to give up control, because you don't. And then so that kind of brings into this sort of stopgap thing that they do with convertible notes and safe notes. And one of the problems with safe notes that they like I think Y Combinator started it, and they've kind of backed off of it, and they started really turning safe notes much more into what looks like a convertible note, because they put all these terms and conditions in there versus like, we'll figure it out in the future. And part of that was because too many entrepreneurs are raising too much money on safe notes, and when they finally got to doing a valuation of how things converted, that entrepreneur would end up with 20% of their company or 30% of their company, and they became an employee kind of a thing versus, and not as incented, right? And so that was, Silicon Valley started putting parameters on it in order to prevent that kind of thing from happening. So sort of, you know, give your perspective on, say, the tool using safes and convertible notes in this awkward area of not being able to figure out what the actual valuation is of the company. And then we're going to talk about the importance of financials and valid financials.
I just thought of a good analogy for the first, as you were saying that. The safe note to me is equivalent to like the no doc loan during the mortgage. Right? There's just like, you didn't need to prove anything. We don't have a valuation cap. We don't have an interest rate. There's just not, you're just going to basically give me some money. And it's, when we raise more money, we'll let you have it. Those terms or something. It was a really bad idea, I think, from the start. It was meant to try to be safe. Stood for, what did it stand for?
It stands for a simple agreement for
future equity. Right. So it was too simple, and it was too much in the future. And so it was never popular in the Southeast or really anywhere. But you know, everything is a little wilder, wester out in the Valley, and investors here didn't want to do that. And so again, you know, entrepreneurs that would hear that, you know, in the national media, oh, Y Combinator, this and that, and then they come to ATA or TIE and say, oh, you know, we're going to do a safe note. Everybody's like, no.
Well, it's funny. Some of the incubators and accelerators are totally pumping out safe notes in our Atlanta market, and I see them, and I'm like, I got no idea how to interpret that, because they put in all these random clauses to try to make it operate like a convertible note. And you know,
do an uncapped note, that's not a good, you know, attractive at all. People want to know what their cap is, and they want to know that they're getting a discount to that cap. And they want the fewer variables, the better. I mean, let's take, you know, the guessing out of it. So convertible notes have always been preferable to safes, but they've always said also investors preferred. So they prefer a fixed price preferred stock to convertible notes also. So in the hierarchy of preferences there.
Yeah. So my probably one of my most successful capital raises when I ran the angel investor group was a company, and this is a good example. They were a company that had come in and had raised money from a it wasn't friends and family, but I call them subjective investors. So it was a biomed product raising millions of dollars from doctors who traditionally don't know how to evaluate company and do invest on emotion, who all were like, oh God, I can't believe that product has never been invented before. I totally want in. And so they had this really high valuation when they came into my group, and everybody loved the deal, loved the potential, but the valuation was just too high.
Right.
And so they were in a thing because they had tapped out. So we went in and did a warrant on it was preferred stock, but they did a sweetener that if they closed at this specific time, they could get a warrant for a discounted common stock. They would still have to buy it, but it would be like it was like a 20% discount. So they would be able to, whatever that strike price ended up being at that time. And so it was funny, man. We had not only, so it was in effect like we did a 50% thing. So it was like doing a down round, but it wasn't a down round, right? Because all in, people were going to be paying about 25% less for their stock. You know what I mean? When it was fully calculated out. But and it took the valuation down a little bit. Like our investors were like calling, well, you said the deadline was 5 o'clock on Friday. You think if I fax over my signature, it's okay if I get them the money on Monday? And I'm like, sure, I'm certain that's going to be okay. and their own things like that. So, to me, that is it's interesting because the convertible note works because people feel like they don't know what the value is going to be, but they know they're getting a win from the get-go, right? It's a 20% tick, it's an interest bearing, it's whatever, however they do it. And I think that's why convertible is a successful way to avoid that what is the value today conversation.
Yep. We touched on knowing your audience sort of also. We touched on the Southeast versus the West.
Yeah.
And that was the other variable I missed in the scorecard method. We talked about the year to date. We talked about the sector. You also have to talk about the region you're in. You have to be aware of your audience. So just because the national median, average for seed stage or whatever was $10 million, that doesn't mean that your seed stage company in Atlanta in ed tech, is worth $10 million. So you have to haircut or give premiums to your sectors, but usually a discount for the Southeast region, unless you happen to be raising nationally and whatever. Yeah. But
so let's read scorecard: industry, stage, region.
So start with a national median, and then adjust for your sector and your region and the year to date market situation.
Oh, that other one. Yeah. Okay.
And then on top, that gives us a new baseline number. And from that, we go through the scorecard and give your company a specific score or factor after about 20 or 25 questions. And those categories are weighted based on with the most weighting going toward the management team and their experience. Have they had an exit before? How much industry experience have they had, and so on? That's a big factor. And you look at market size, you look at competition, you look at any intellectual property, you look at their funding needs and other miscellaneous topics. But you end up with a factor of greater or less than 1, with 1 being par. So if all the other things add up to come out to a $5 million valuation round number, and your factor is 0.75 on your company specific score, then you're at 4 million. But if it's 1.25 or whatever, then you're at 6 million. So it comes out with
interesting. Wow.
Right, but it's very company specific and industry specific and region specific. So it's a much better number. Clients really like it, and I offer the whole exercise transparently for just $1,500. And this came up at our tying meeting last week. A guy, I mentioned I did valuation, and he lit up. He said, "I need you right now. We've got we need to raise money, and the founder thinks we're worth literally $60 million, and I'm trying to talk him off the ledge. And I said, yeah, I can help you with that. I described the scorecard method. I said, we'll educate him. And he said, how much? And I said, $1,500. He said, only 15, that's all? And I said, well, I can charge you more, but there's no math, is it like a DCF market, there's no complicated Black-Scholes option pricing model thing here. It's just, some data and some adjustments, and I need you for about an hour and a half on a screen share call to go through this, and I'll do some research before and after. So, I don't need to charge you $10,000, for this exercise like a bigger company would. So I think it's helped make me very useful in the local startup community to just be of service to them and try to get them going. And I've gotten great feedback from it.
Yeah. Well, and that's just also great because I think one of the reasons why private companies don't, particularly ones that are raising capital, they think it's going to be a lot more expensive than what you just offered. So they don't even broach the subject because there are bigger firms, right? That's the beauty of you in your firm and having the low overhead. And you having a very sort of predictable model that you're using. Then it's, could be fixed price, kind of like lawyers that will do they have a PPM that, 90% of the language is the same. So they've gone to independent lawyers have gone to a fixed price that is, a tenth of what some big law firm would charge,
Almost in lockstep last year, there was inflation, valuation prices went up, and I try to keep up with my friendly competitors, and everybody was charging about $10,000 for a valuation.
Yeah. Okay, so let's we got a few more minutes for us to keep chatting here a little bit, because I want to get into this idea where like private companies, ones that like we talk about, have gone up with a wrong valuation based on not having the proper advice. And so sometimes they'll use this market comp, right? Because they may not, they have this reasonable valuation, and then they'll say, well, our market comp future, and they do, like, I loved it when you did the example of this is what the house down the street sold for, and it's got the same number of rooms and bathrooms and things like that. And so they try to do that says, oh, I'm like Facebook, and so Facebook was this amount when they went public, so we're going to be worth that. And so it's a really good deal, and that's what your like return on investment is going to be. And that's so, smoke and mirrors, right? It can't even go there. So let's talk about this problem that entrepreneurs have, and for the investors that are listening and they see these guys that'll have a hockey stick, the hockey stick of revenue. And I always say that is an immediate indicator that they don't know actually how they're going to sell it to their customer. And so they go with, if we're just 1% of this huge market in 5 years, and then they just kind of back it up to where it is, but they don't actually know how they're going to sell it or how they're going to get that 1%. So talk about when you're looking at a company and you've seen they've done that, or they're struggling with figuring out their value and they haven't really done the homework to figure out how they're going to generate the real revenue, right? To the scale revenue. Right. It's because I say, the realistic thing about somebody's financials is that it's always seasonality. There is never where it's going to go from point A to point B in a straight line. No business generates revenue that way. And so you have attrition, you have sales cycle, you have all these very new products coming in that are going to add to the revenue. So can you get a valuation from somebody that hasn't done that homework? Or do you make them go, oh, let's put the brakes on this. You got to go do this before I can give you the actual valuation?
Yeah. Yeah. A few years ago, everybody was the Uber of this and the Uber of that, right? That to the Facebook point. And so this is where, my 20 plus years of experience with early stage companies comes into play and is valuable, pun intended. Other valuation firms, a lot of them, they want big projects. They want, billion-dollar companies that'll pay, $50,000-$100,000 valuation fee, litigation, and I love litigation because I destroy other valuation experts in court. They're so just all over the place. Undefeated so far.
Yay.
But so the learning curve, even at SVB, as hard as it was to work there at times with the volume and everything, you got sort of trained through a fire hose. And when I started there, it was still even early for everybody in the industry valuing these companies. And you want to give early stage companies, as I said, sort of a future look and the values of present value of future cash flows. But if the cash flows, you're relying on a forecast that's uncertain. So if you just take those hockey stick projections on faith and on goodwill, at first people were taking them more, on good faith. But when you did it for a couple of years and then you'd come back and do the 409 every year and you see that they almost never made their forecast.
Yeah.
That you're overvaluing the company every year and you're haircutting it year after year after year. So if you're blindly taking a market multiple because they don't have cash flows to do DCFs, and you're taking a median multiple on much bigger companies, you're going to overvalue that company every time. So we started two things to get more reasonable, fair, accurate valuations, was using fewer forecasted years of revenue in the average calculation. So we'd apply a multiple to the last 12 months revenue and then maybe the next 2 or 3 years to try to blend a future look. But as I said, seeing that wasn't working, then we'd pare it back, over time and future valuations of 2 years, 1 year. Most of the time, I'll just use an LTM revenue multiple now, because the next year, if you're already now in you're toward the end of the year and you have the first half financials and they've done 2 million in revenue through June and they're forecasting 8 million through the rest of the year and 16 million next year and 32 million, and you're like, not going to happen. So let's just, pare back our expectations and choose our multiples and our time periods accordingly. And that's how as well as considering that size to multiple calculation, those are some important nuances, that help me come up with a better answer than firms that aren't as experienced in the early stage world.
Okay, so very good. So let's see. I wanted to make sure we covered the revenue piece of this. Oh, so let's go to sort of the tangible when it's a company that is, got 10, 15 million in revenue. They're still a private company. They're either queuing themselves up to sell and they want to kind of figure that out, what it is, because I know that's a point a lot of times when I saw, a lot of us know a gentleman who had just recently, one of our members of our community who recently moved to Europe, who was very much in the valuation space. I think you probably know who I'm talking about. And he had done a post not too long ago where he does the valuation for companies selling and a company getting ready to sell. And they have this wish list. I'm going to sell my company because I want to make $10 million when I sell it so I can retire on that. But they can't find a buyer for that because their numbers don't make up. So that's where the similar thing of an entrepreneur that's starting up thinking that they're worth, because it's, there's a different kind of motivation, but it's the same. But when it comes to a company that is a going concern, that's profitable with millions in revenue, they're either getting ready to sell or maybe thinking about doing a Reg A plus, raising capital that way. Talk about the traditional stuff. Earlier you talked about, cash flow and EBITDA and the multiple on revenue and stuff like that. But where does something else come in when it's like, inventory and equipment and assets and a customer base and goodwill, that old vague goodwill that's on the balance sheet? Talk about how you look at those factors when it's a going concern within the intangibles of industry and sector and so on and so forth.
I have a great case study, and I'm going to hold off on the goodwill and intangibles part of it, but this is still a really good thought exercise. So client, let's pick some round numbers, substantial services-based company, professional services, let's just say 10 million. And partnership buyout situation, right? So there's a 2/3-ish, or let's call it 3/4, 1/4 ownership structure. So the minority partner comes in and says, I'm leaving. And the controlling partner says, okay, what do you want? We don't have a specific operating agreement other than to say we'll get a valuation. And the minority partner says, well, I hear that revenue multiples in our section are, let's just say 5x, and we're doing 10 million, so that the company's worth 50 million. I have 25%, just so give me 12.5 million, and I'm out. And I don't think so. So first of all, that's a revenue multiple. Now, again, two companies with the same revenue have very different profit margins, are going to be worth different. And we want to look at the present value of the cash flow. So they are profitable, and we can do that income approach. But again, one reason larger companies are more have higher multiples is because their margins grow as they get bigger. So these smaller companies, they had very, their margin wasn't great. So we get into the DCFs and we get into those, what we call normalizing adjustments. Maybe there's owner compensation. Maybe they're paying themselves too much, maybe not enough. Maybe they have some, they have cars for company cars, and they've got a spouse or a kids on the payroll. You got to adjust for kinds of those things. And so once we sifted through all that stuff and did a discounted cash flow, that thing was, hardly not worth much. And that 5x 10 million 50 turned into just a few million, and 25% of that few million was even less when the discounts for lack of control and marketability applicable to a minority ownership interest in a illiquid company whacked it down another 40-50%. I mean, the partner leaving came out with a small fraction of that initial revenue multiple expectation. So that was a great case study example for why not to use revenue multiples in valuation.
Yeah, I had a similar sort of thing one time with a guy that was looking for, I was helping him to prepare to get a loan, and he was a franchisee and was wanting to buy his own building and do all this stuff, right? But he had done exactly what you were talking about. He had 3 companies where this one had the cars and the equipment, and it was paying that, and he had named it, he had all this stuff because he was doing his books for the tax man. And I'm like, you're going to have to bite the bullet and do your books for the bank for a year and get readjusted. We have to do you're going to have to do a readjustment of your accounting and, all these things with comments, and then actually show financials where you have revenue, you pay taxes on, or you'll never get a loan because you show no revenue. Right. And, and that's the same thing with companies that have been sole proprietors and they've had a lifestyle business for a long time. And, like in the example where next generation, right? The next generation family wants to come in and they want it to be a generational business, but they want to expand or they want to do this stuff, and their hands are tied to go raise capital because the way it has been run as a lifestyle business, and it doesn't look like it has the profitability. So there's a golden nugget for those out there listening that says, be prepared. You can't, you're gonna have to, there's always a price to pay to be able to show the true value of your company and be able to get additional capital, whether it's lender or an investor, to grow your company to that next level. And so start early so that you can know where you're going on this. So you're prepared. If you want to sell your company in 5 years, get an expert to start figuring out, and then figuring out what you can improve your numbers so you can get the kind of multiple that you're trying to get with that.
Yeah, it to that point in this sector in particular, what I found with this partnership buyout was that margins were all over the map, in their comps. And it from like 5% to 50%. I'm like, so obviously a company that's got 50% margin on 10 million netting, 5 million versus one netting, 500,000, they're worth very different things. So I had to like ask a lot of questions like why is your company performing this way versus those making much more. And so to your point about trying to prepare for the future, if you think about those things, how could I improve my margins? What am I doing differently? What are they doing better that could make my company more valuable? Maybe I should be, there's different sort of subsectors within industries. If I add a different product, or if I, even though I'm professional services, could I do more in any sort of automated way? Do I want to get into a different little product line that's more profitable? Things like that can turn a business around.
Yeah. I'd say great. So as we wrap up this and we get ready to go into the hidden joy passion project thing, one of the things that's also a best practices, and this is when I tell people to go get more information and connect with Gregg about this, go to Integgra .com, INTEGGRA.com. Very similar to how Gregg's first name is spelled. We all went through how do you spell his last name, but Gregg has 2 G's. So Integgra.com, and his email's Gregg@Integgra.com. Both 2 G's. And get some information about this, start having that conversation, because a lot of places require a third-party independent person to do, or organization to do valuation, particularly in these things like you're talking about with the buy-sell agreement, or when there's some kind of legal reason to get a valuation. It's really important to have a third party. And then for the people that just know because they're doing the stock options or whatever, you want to have something, you have to do it every year. That's when you have somebody like a Gregg that is understanding the whole, like they already know your company, and they can adjust it according to what has happened this year. So you're not starting from scratch every year on that. It's good to have somebody just like you do with an accountant or a CPA or something like that. So is there an actual law or something about a third party? Like in bankruptcy, you have to have if somebody had been having somebody like yourself doing their valuation all the time, would a bankruptcy mediator require a third party, or would they just look at your credentials and say, okay, yeah, you're objective and this has been consistent over this period of time?
A couple of things in there. I mean, it may depend on a buy-sell agreement. Certain things, I haven't done a bankruptcy case per se, but I've done several litigation projects in arbitration and in the courtroom. Interesting that there's no, in business valuation or appraisal, there's no specific designation or anything required. It's just education and experience. So, I think the designations in the sector have, fallen into question and over time, and why do you have to pay for such things? I don't know. So in COVID, people don't want to they don't want to go through these processes, and so education and experience has always been the standard. And but the 409A, it's not it is a IRS requirement. It's not so how much they actually look at and review and audit these things maybe about as often as people get audited in their personal taxes, but it is a requirement out there officially to have options valued independently. And partnership buyouts, it would depend on a operating agreement. You might have none, one, or two, multiple, or if you have two and they're too far apart, you might need to get a third. Depends what you agree on up front. But even family law, sometimes, as you mentioned, there's a divorce and a spouse would get half of the value, and one side might be a little too biased and they might argue for twice the value of a company. And I've seen this, boy, have I seen this. And they so if they get half of 2x, they end up still getting the whole thing, right? So it's not really fair, but they'll try. But it's often easy to discredit unrealistic forecasts and unrealistic multiples. And that's how you go about winning in those situations.
Yeah, I had an investor, one of my investors way back, come to me because he was getting a divorce and he had to come up with a valuation for all of his private investments. And I was like, well, they haven't reached their value yet, right? I said, you need to assess where they are and get, their current thing, but they're not necessarily worth the value that they set on paper that you invested in, because that is based on a future expectation that hasn't happened. I think you could probably argue that your spouse is going to want some other asset that's got a tangible valuation versus some of this intangible that could be worth nothing.
Right.
And
Last week I
yeah.
heard, well, we're going to acquire a bunch of companies in the future, so we're going to grow that way. Can I take credit for the valuation of, that in my forecast? I'm like, heck no.
Yeah. All right. Super. Anything we haven't covered on valuation you want to cover, Greg, before we move on to the joy?
I think we hit the most important points for the time that we have.
Okay. Very good. Very good. So here's the thing. Greg has written a book called The Gridiron Legacy, and it follows the career of one of the game's earliest, being like, this is professional football, game's earliest greats that bring the backstory of professional football to light, solve the cold case that caused it to be forgotten. Ooh, intrigue. And you're the great grandson of the main character of this book, right? So
Yeah.
tell about this. Has this been a passion project for a long time? Like, did you always know your grandfather's story and said someday I'm going to do this, or did you discover it, like more recently, and then it was just figuring out how to get it on paper? Talk about how this came to life.
A little bit of all that. It's a family lore story that I've been blessed with and inherited, not just the story, but some photographs from my great grandfather's personal collection of his career as one of the greatest players and the greatest center of the pre-NFL era of pro football. Isn't it an incredible thing to think about, as huge as football is, our biggest sport, that nobody knows how it started, right? People, even players that are in the Pro Football Hall of Fame, I've had conversations with Troy Aikman, Jerome Bettis, big names. And like, okay, why is the Hall of Fame in Canton, Ohio? I mean, your bust is bronze in Canton. Troy said, well, that's where pro football started, right? I'm like, no. He said, where did it start? Pittsburgh. What? How's that? Well, it started there in 1892, and for 10 years before it moved to Ohio when it didn't work out in Pittsburgh financially, and they kept it going in Ohio, and that led up to this big scandal that killed it all in 1906. And then it died for about 10 years. A fellow named Jim Thorpe came around, who was a national hero.
Oh, sure. We know that name.
Right. Everyone knows Jim Thorpe, but not exactly like they know he won gold medals in the Olympics, that they took his gold medals back because he took like $20 to play in a baseball game in one summer. And he got them back posthumously just a few years ago. But he sort of resurrected pro football. Everybody wanted to come see him play. And from like 1915 to 20, it grew again so big with his help that the NFL was formed in Canton, Ohio in 1920, which is why the Hall of Fame is there, not because pro football started there. So that's kind of it in a little quick nutshell. But what I knew growing up in Pittsburgh is that my grandmother had 3 of his wonderful team pictures on her wall in her basement, and they were just captivating. And so that planted the seed from the very beginning that there was something special about him, and that he was the patriarch of our family, and he was a very successful business person afterward based on his reputation from football that he leveraged to be a professional business person. So a lot to try that wasn't known there even by my grandmother about his football days. But when she passed away, in 2007, about 15 years ago, I was cleaning out her house and found a treasure, a chest of his more photos from his
Oh,
football career. And right away, I'm like, boom, this is huge. I've got to figure out who all these teams were, players, and get to the Hall of Fame, and which I did. And we all, figured out that it was the most unique, special historical collection known. And
wow.
they said this was like finding an original constitution to them. And they said this would make an incredible book, coffee table art sort of book, but you need to add the narrative. And there's this cold case out there about this scandal, and nobody knew exactly what happened, but it was kind of like the Black Sox, in the Field of Dreams and Shoeless,
Uh-huh.
that there was allegations of game fixing, but it was never really proven. Nobody knew if they were guilty or not, or who did what. So what can you go out and figure this out? And oh, sure, it's just been over 100 years. I got lots of time in my hands. So, but with some help of some allies and friends along the way on the yellow brick road and the hero's journey, as it were, I did solve it, and I found a missing court file, in Ohio,
Wow.
just like in the movies. And there might be a movie here one day. We're working on it. The depositions from a court case that never had its day in court, but the Canton captain sued the Massillon newspaper and team for libel, for accusing him of being part of this scandal, this scam. And so he ran out of money, though. At least officially, he could have been paid off to give up the case, or knew he was guilty and quit, or whatever. Nobody knew, but he went down in history as a bad guy, and he never admitted it. So
Huh.
question forever was, were these players sort of complicit in sort of tarnishing the origins of the game? And for that reason, I think their story has been lost, and they haven't been honored appropriately for being the founders and pioneers of pro football. But wouldn't it be great if the case proved that they were innocent, and it would give pro football something to be more proud of in terms of how the people that started pro football. And that's really, it's sort of a redemption story, and which Field of Dreams was as well. When you think about all the Kevin Costner and his father and Shoeless Joe and all the players that were accused of doing stuff, James Earl Jones, who wanted to write again, and the doctor who never got to play, Burt Lancaster, pro base. All these people needed to be redeemed and fix something from the past. So this book fixes the history of pro football, and I think it's pretty special, and I think the Hall of Fame agrees. So I've been doing radio interviews for the past couple of days. It went on Amazon on Tuesday, and we're
Oh, okay. Really recent.
doing a full launch. We've had a soft launch last year that was very successful. I was #1 on Indiegogo for a couple of weeks, but we're going for it right now during football season.
Oh, very good. So go to Gridiron Legacy, GRIDIRONLEGACY.com, and it's in the show notes. All these links are in the show notes. If you are a football fan, someone that is a football fan, we have a whole bunch of, some people in my husband's family are really fanatics on professional football. Get this book. Don't wait for Christmas or Hanukkah or whatever's coming down the road. And what a great, I'd seen the book when you first came out with it. And I think it was last year, maybe it was a part of the soft pre-launch.
Right.
I'd seen the book. It is a beautiful book. It is just a beautiful book. It's a heavy duty book, but like you say, the pictures and the things like that. And I did not realize it had this cold case story in it. And that's really intriguing to me. So
Thank you.
I guess it's good. So congratulations on that. Congratulations getting it all done. I know those things always take longer than you expect. And hopefully, fortunately, you probably had good editors and people like that, because I know even after my editor went through my book, Inside Secrets to Angel Investing, I was still, because I was you know, in that particular case, you knew all your facts, but I was like, oh my goodness, is there anything wrong with this? Because I didn't want to put it out there.
Exactly.
And right. And so
Takes,
they
right?
call it right. And so I
Grammar, yeah. Editing, I was so obsessed with and so fearful of being, you know, labeled a hack for
yeah.
and so painstaking. I I had 5, 6, 7 friend editors, and before I went to like the professionals, and we would still fine tooth comb finding little things until the very end, and then it went to print, and I was like holding my breath, looking through the the first hard copy, and I found a little errant apostrophe on one, and I'm like, "No!" And then people would read. One guy called that bought it with a little fact check, and I was like, you know, you're right. And so we did a second printing, and I fixed, you know, a couple little things, but I
yeah.
people don't notice.
Yeah. I'm so far so good on mine, other than things changing and wanting to add or, you know, definitions, some different definitions in mine, because I have a glossary at the end of all the different terms that you use in the capital thing. One apostrophe, that's all that's been put towards me so far. So I'm and it was on, or was it or something, it was like it was within the context of my angel investor group, network of business angel investors. So I probably would be the only person that would have caught that it is investors and not, you know what I mean? Just
Yeah,
like in
the
the
possessive
context of it,
aspect.
right? And so, you know, I found that I was like, so I've marked it and I keep going because, you know, I want to do, you know, it's good to do a second edition now and then and update things. But so
Might
that's
even
really
have
terrific.
paperback. That could be the next thing. Some people, it's so big and beautiful. It's a man cave thing. Looks great on the coffee table, but I can't take it to the beach and or in the plane. So I might do
Yeah.
it.
Yeah. Yeah. So, so very good, Greg. Thank you so much for taking the time out. It's been a long podcast. Thank you for everybody that has stayed on tuned and listened, and you now are smart about valuations, and you now know there's this secret sort of story of intrigue in the history of football. So there you have it. It was a twofer.
Thanks, Karen. It's been fun.
Thank you. So onwards and upwards, everybody. See you next week.